Hello viewers, I'm happy to welcome you all for this video. In this video, I'll be telling you how to do Fama French three-factor model. See, it is one of the advanced model of capital asset pricing model. So let us see how to do it. So before going into the working method of Fama French, let us see the introduction. See, Fama French is describe the returns of portfolio with markets. That is, normally the traditional asset pricing model, that is CAPM, uses only the beta to describe the returns of portfolio with market returns, whereas Fama French model uses three variables such as market, size of the portfolio, and value of the portfolio. This model uses SMB and HML. SMB is like a small minus big. That is, we have to take a market capitalization. That is a small funds market capitalization minus big funds market capitalization. And HML is high minus low. For this, we have to take book to market ratio. That is the book to market ratio, high funds book to market ratio minus low funds book to market ratio. It measures the historic excess returns of small caps over big caps of value stocks over growth stocks. SMB. It is the difference, that is small minus big. It is the difference between the average return of smallest 30% or 50%. You can take any percentage. See, the author Kent Womack in his article, he specifies that 30 percentage of funds is sufficient to calculate SMB. So I also have taken 30 percentage of funds and the average return of 30 percentage of the funds assets. The positive SMB indicates that small cap stocks outperformed large caps, and the negative SMB indicates the large capital funds are outperformed in over low caps funds in a particular month or year. For this presentation, I have taken monthly returns of funds and HML. HML has been constructed to measure value premium with the high book to market values. HML is calculated as the difference between the average return of 30% of schemes with the highest book to equity and 30% of the schemes with the lowest book to equity of the scheme. So this also may vary. That is, top 5 and bottom 5 we can take. 30 percentage of funds you can take, or 20 percentage of funds we can also take. See, this 30 percentage is given by Kent Womack 2003. So in this presentation, I have taken 5 top and bottom performing funds. A positive HML indicated value schemes outperformed in a month, and a negative HML indicates growth schemes outperformed in a particular month. See, in order to do a form of French, we have to take we have to calculate coefficient of market return minus risk-free rate of return, and coefficient of SMB and coefficient of HML. So this can be obtained by regressing return on funds minus risk-free rate of return. So with the RM minus RF, SMB and HML. These coefficients are substituted in Fama French three-factor model to obtain the expected rate of return. Additionally, actual rate of return of these schemes have been calculated by using the historical values of the past years. Say now let us see how to calculate to form a French model using Excel. So for this already I have taken a data. So that is, I have taken nearly 30 schemes, that is 30 mutual fund schemes. Say that is Bharti AXA, Escort, JP Morgan, like that 30 schemes I have taken, and the asset also I have taken. So in to calculate SMB, we have to reduce, that is small minus big, that is the funds those whose values or asset, that is average performance of lowest asset funds minus higher asset funds. So for this I have taken this is, that is assets of all funds, and I have sorted out. See, that is lowest to highest. The lowest asset value is by Bharti AXA tax saving fund, and then highest asset value fund is SBI Magnum. I have taken this, and say I have taken monthly return of the top 5 and bottom 5. So this you may increase, that is you can take 30%, that is 9 schemes, or you can take 20 percentage, that is 8 schemes, like that. For this presentation I have taken top 5 and bottom 5 funds. So this is NAV return of this particular fund for a period of 3 years I have taken. Say that is from March 2012, and that is from March 2009. Right, so this is return in percentage, but we need to convert this into values. So that's why I have done this. That is equal to the return value divided by 100. It gives the values, not in percentage. So you just click and drag it, or you just copy it and paste it. Right, so same thing we have to do it for other funds also, that is equal to next scheme divided by 100. So like that we'll just copy and paste it. I just copy and paste it to all the 3 years of data, right? So now we have to calculate the average value of this fund. So that's what I have already calculated, average of this. Again, this will make it copy and paste it to other funds. Right, now we have calculated average of lowest performing funds, that is return of lower performing funds. Like that we have to calculate average. So like that we have to take we need a return of these funds. See, by mistakenly I have deleted. Let us take all the return from already. I have it in another file. Let us take it. See, already there is a return, copy, and we'll paste it in a file. Right, so same thing we have to convert this into values. Now copy and paste it to others. And again we have to calculate average of this. Right, so actually here we are having average return of higher performing funds, and this is average return of lower performing funds. Say we need to calculate SMB. SMB is small minus big, that is low minus high. That's what we have calculated here. That is E15. E15 is the average return of lower performing funds for the month of March 12, and same thing. And in E40, this is average return of higher performing fund for the month of March 2012. Right, so like that it has been calculated for all the 3 years. That is every month it has been calculated. So this is SMB for these 36 mutual funds. Like that we have to calculate HML. See, to calculate HML we have to take book to market. This book to market ratio can be calculated share price divided by book value. So share price for the particular year it has been taken, and the book value is by default it is 10. So that has been calculated. That is E by F, that is book value divided by share price, will be getting book to market. And again for this also it has been deleted. We'll take it from another file. That is so this NAV return already I have calculated. Like that you also need to calculate the return of all the funds. So and same thing higher performing funds also. Like higher performing funds return. Right. So this is the return of high minus low. So that is based on the book to market ratio. It is started. That is a higher minus lower. Right. And again the return ratio, that is it is in percentage, that is calculated in numbers, that is values, and again average is also calculated. So same thing here, this is uh, return. This can be calculated into values here. Right, copy and paste it. Right, see, that is you just to see the asset price. So this is higher performing to lower performing. So HDFC share price is high, whereas if you see asset, SBI Magnum is high. And again lower JM tax gain based on the share price. If you see asset, Escort is the lowest asset. So like that again we'll calculate high minus low. So this is the average of low performing value stocks, and this is high minus low. That is high value stocks are in H40. That is and that's what high stocks are in H40. Sorry, I think this is high minus low. H14 minus H40. You just drag it. Right, so we have calculated SMB and HML. Right, so SMB are calculated here in this sheet, and high minus low is here in the sheet. So now we have to calculate expected rate of return, that is Fama French value for every stocks. So for this, I have taken like this. That is for 3 years monthly return, and this is the return of tax saving mutual fund schemes in percentage. We need it in values, so convert it into values. And again, risk free rate of return, that is 8.7. Again, we need monthly return, so that is converted into monthly return and in values. This is RI minus, or that is return of the fund minus risk free rate of return, and this is the market return of a particular month. That is for this I have taken Sensex market, and this also converted into values, and RM minus RF, SMB, HML. So for the purpose of analysis, we'll be taking RA minus RF, RM minus RF, SMB and HML. So that is given in the PowerPoint. See, that is coefficient of Rm minus Rf, SMB, HML, that have to be regressed with Ri minus Rf. So that like that only will be getting a coefficient. Right. Say now, in Excel there will be a data. Say you just take all the basic data like this. We need a return also, that is for average, or that is return for a particular period. So here I have taken 3 years. To 3 years return I have taken. So for that I have taken the share price also. That is March 12 and March 9. So these are all the basic data. We'll just prepare a sheet like this, and we have to do regression on this data. Go to in Excel, there is a data tab. So in data there will be a button, there will be an option called data analysis. So in certain Excel it is an add-on. In certain Excel, data analysis will not be there. So in such cases, go to file and click on options, choose add-ins. So in add-ins you have to install this analysis tool pack. So insert this analysis tool pack, then only the regression and correlation, all the analytical tools are inserted. So already I have inserted here. So click on analysis, see all the analytical tools are here. ANOVA, correlation, and F test, histogram, moving average, everything. So for this we need to calculate coefficient of all these elements. So choose regression, click OK. So it is asking input range Y and X. So we have to regress this RM minus RF, SMB, HML with RA minus RF. So here the input range is, select this Ri minus Rf, and in X range you choose all the three elements, that is Rm minus Rf, SMB and HML. And output range you can keep output in the same sheet or new worksheet or new workbook. Say now I place this in the same sheet here, right? So choose, click the top origin alone and click OK. See, automatically the summary output is inserted here. So this is the regression of results. Right, so multiple R square, adjusted R, standard deviation, residual, significance, everything is there. Say this has its own explanation. So for calculating this Fama French, we need this three variable, that is coefficient of Ra minus Rf, SMB and HML, right? So for this already I have given formula here, right? So this is the formula. That is risk free plus coefficient of like coefficient of Ri minus Rf into sum of this, and again SMB and HML. So this is the formula, right? So after that is coefficient of SMB, HML and Ri minus Rf. With this we have to add risk-free rate of return. So this is the required rate of return, that is expected rate of return. And this we have also have to calculate to compare. This is the actual return. So I told you now already it has been taken. That is previous return, current return minus previous return divided by previous return. This is the formula to calculate rate of return. So this has been calculated. See, the required rate of return for the Canara Bank is 0.36, but the actual return is 1.33. So like that it has been calculated for all the schemes, right? See, that is I have separately placed every sheet, that is all 30 schemes. You see, that is LIC, Shahara, Franklin, like that I have calculated required rate of return of all the schemes. And finally, it has been consolidated in the sheet. So that is, say for example, Reliance, RM minus RF, HMB and HML, and expected rate of return, actual rate of return differences, right? See, that is, it has to be consolidated and make it in a one sheet. See, now based on this differences and the difference between expected and actual, you can interpret, right? So if the difference is lower, the fund is performing as per the expectation, and if the difference is too high, the fund is not performing as per the expectation. So like that you can give interpretation, right? So like this you can calculate Fama French three-factor model. You can do analysis based on this. Thanks for watching this video. Thank you.